Good morning and welcome to Killik & Co.'s podcast for the 17th of June. Last week we commented that with a sort of general lack of sort of news around, that we may hope for a slightly steadier week, and in fairness we got that. Monday and Tuesday were typically a little bit weaker, but recovery towards the end of the week meant that most of the major markets, including Japan, were able to post gains over the course of the week. Looking ahead, the key event for us this week is of course the rate decision from the FOMC, and more importantly the comments that are attached to it. 7 p.m. British Standard Time on Wednesday we should be hearing from Ben Bernanke, and choosing his words carefully is really the theme, because last month, as he referred to the tapering or possible tapering of QE under certain economic considerations, has really led to very much changed conditions in most financial markets. Taking the bond markets, the government bond markets, we've seen yields rise, certainly starting off in the US, but really prevalent right across the world, as the thoughts that as QE begins to taper, then of course rates will rise, and that has had a knock-on impact to equities. Whether that was the consequence of his words, we will be, I'm sure, shed a little bit more light on Wednesday of this week, because if he wants to moderate the tone, come across as slightly more dovish, these are all the thoughts that are going through one's mind as we approach that key date on Wednesday. But Monday has started well, equity markets enjoying some good gains. Japan was up around 2.7% overnight, building on say last week's rather modest gains, but certainly heading in the right direction. US 10 years are heading around 2.14% as we go into Wednesday, so markets calm but slightly on the positive tack. So the diary that we have obviously highlights that. We will also on Wednesday have meeting minutes from the UK, and indeed we'll have some inflation data out this week. Just turning to some of the companies that are reporting, we have results on Wednesday from house builder Berkeley Group and technology group Imagination Technologies, one which we'll be keenly focused on. And on Thursday we'll see Ashtead, which has been one of the top performing equities since the beginning of 2013. So just taking a look at some of these sort of key charts as we go into the week, and this is that chart of the US 10-year gilt yield. This is the money or the interest that you would receive by investing and lending money to the government of the US over a 10-year period, and we can see there that really yields actually did start to turn towards the end of April, heading up from sort of 1.65% to 1.9%. Bernanke's comments last month coming around this point, and that's really sort of continuing that upward trend. But having hit the peak of around 220, there were some rumours around that central banks were getting more involved in 10-year paper and away from 3-year paper, which is their normal domain, and we have seen yields back into around sort of 213 as we speak going forward. So really going to be a fairly critical chart for determining the course of financial markets over the next few days will be this particular chart. Here in the UK, just really to highlight that it's not just the US that's seen higher yields, and just really saying that the UK has burst through the sort of 2% level, hitting again a high of getting close to 2.2, but again just shying away, so very similar trends developing there. And what's this done for equities? Well, certainly for most equity classes around the world, if not all, we have seen some retracement. I did want to highlight that despite a lot of noise that's coming out from the fact that we've seen these falls in stock markets, the S&P 500 has behaved fairly maturely in that period of time. It's really only retraced by 3 to 4% from the peak at the moment, so it's probably been one of the best performing markets in the last 3 or 4 weeks. Year-to-date gains of around 15% there, so just taking the top off of the US markets at the moment. Contrast that with the UK. The UK has been hit quite hard. 68.50, 68.75 was the peak that we saw mid-May, down to sub 6,300 at one point. Just a little bit of recovery building here at the moment. We are being hit also by the fact that a lot of the mining stocks have been hitting new lows again during the course of last week, although towards Thursday and Friday again we saw bounces in stocks like Rio Tinto and Billiton, so there is some sort of bargain hunting that's taking place in the mining sector at the moment. In terms of some of the stocks that have been hit over the last couple of weeks that we would like to highlight, rising bond yields do have an impact on some of the insurers, and the Prudential, which has been really a stunning performer against its peer group because of its exposure to Asian markets, has been hit for the very same reasons. Asian markets probably being hit the hardest on the way down, and as a result Prudential has been caught up in a little bit of that. So having peaked around £12 mid-May, back down to 10.50, just bouncing off 10.75 at the moment. Never easy buying these stocks as they enter into a downtrend at the moment, but it is one that we feel has created an opportunity for a buy recommendation this week. Another stock that has been hit hard is in the utility space. Is National Grid. It's often referred to as a bond proxy type investment, utilities, because of their ability to pay out very high dividend yields, and again, as bond yields have risen, it has meant that in the near term utility stocks lost a bit of their appeal on a relative basis, but having come back from 820 back down to the 740 level, it feels like there's steadier progress there with a yield of 5.5%. Again, research have highlighted that stock as one which we think could be a good buying opportunity in National Grid. And finally, just a little bit sort of off the press news. This is the chart for Fidelity China Special Situations. It's been revealed this morning that Anthony Bolton, the Star Fund Manager, is going to step down from 31st of March 2014. It has meant that the discount on this particular fund has now moved out to its widest level since 2010. It's trading at around 11% discount at the moment. Our expectation is that Fidelity will step up the buyback programme on Fidelity. We don't think they'll want to allow the discount to widen to, say, 15%, for example. So a good entry point potentially there. And the other thing we have learnt is that the fees on the fund will be cut. Currently fees around 1.7%, reflecting the star status of Anthony Bolton, so those fees could be cut. So it may be an opportunity on the weakness on that announcement this morning, again, to pick up shares in this fund on, as I mentioned, the widest discount since 2010.